Have you ever wondered why keeping your cash in the bank might not be the best strategy for wealth building? Well, you're in for a treat because today we're exploring how to 10x your investments with assets that go beyond mere cash. Welcome to another thrilling episode of Fun Financial Insights, the channel that transforms complex money matters into an exciting adventure. Today we're diving into the wisdom of Robert Kiyosaki, the maestro behind the Cashflow Quadrant. Get ready to unlock the secrets of financial success with Robert Kiyosaki's advice on assets that are better than safer than cash. Stay tuned. We will also share these tips on how to convert your cash to assets fast. Let's kick things off by addressing the elephant in the room. Why shouldn't you keep all your cash in the bank? Now, Robert Kiyosaki's Cashflow Quadrant sheds light on the different ways people earn and utilize their money. The Cashflow Quadrant is a concept introduced by Robert Kiyosaki in the book Rich Dad's Cashflow Quadrant. It describes 4 different ways of earning money, and they are employees, working for someone else and earning a salary, self-employed, running your own business and earning money through your own efforts, business owner, owning a business that generates passive income, and investor, investing in assets that generate passive income. According to Kiyosaki, those struck in the employee and self-employed quadrant often end up with their money working against them. Why? Because they're more likely to hoard cash, missing out on the wealth-building opportunities that lie in the business owner and investor quadrants. Hoarding cash might seem like a safe bet, but inflation erodes its value over time. Your money isn't working for you, it's losing purchasing power. Kiyosaki's philosophy challenges us to shift our mindset from job security and saving to embracing the world of assets. Before we dive into why assets are superior to cash, let's clarify what assets are. In the financial realm, assets are things that put money in your pocket. They generate income and appreciate over time. Cash, on the other hand, is a liability in Kiyosaki's terms. It doesn't work for you, you work for it. Now let's explore why assets trump cash. Assets have the potential for growth and income generation, while cash simply sits there, often losing value due to inflation. The goal is not to just save money, but to make money work for you. Now let's get down to the nitty-gritty of 10xing your investments with 4 assets better than cash, as per Robert Kiyosaki's Cashflow Quadrant. Number 1 is business. Kiyosaki places a strong emphasis on transitioning from being an employee or self-employed to a business owner or investor. Starting and scaling a business can be a powerful wealth-building move. Let's break it down with an example. Sarah had just received an inheritance of $100,000 from her grandmother. She was considering what to do with the money and had 2 options. She could either put it in the bank and earn a modest interest rate, or she could use it to start her own business. After careful consideration, Sarah decided to take a risk and use the money to start her own bakery. She had always loved baking and had a dream of opening her own shop. She took a course in business management and used the rest of the money to rent a small storefront, buy equipment, and stock up on ingredients. At first, the going was tough. Sarah worked long hours, often staying up into the night to bake and prepare for the next day's customers. But she was determined to make her business a success, and she poured her heart and soul into every pastry she made. After 5 years, Sarah's bakery had grown into a successful business that brought her in steady income and allowed her to live comfortably. She was proud of what she had accomplished and knew she had made the right decision in taking a risk and starting her own business. Now let me ask you a question. Do you think Sarah would have been better off if she had put her inheritance in the bank and earned a modest interest rate? Or do you think owning a business was a better choice for her? Real estate is another avenue Kiyosaki champions for wealth creation. Let's say you invest $50,000 in a rental property. With rental income and property appreciation, your investment might grow to $75,000 within a few years. Here are some key points to consider when it comes to real estate as an asset. Number 1, physical property. Real estate is a physical asset that can include residential, commercial, or industrial properties. It can be a single property or a portfolio of properties. Number 2, income generation. Real estate can generate income through rental properties, which can provide a steady stream of cash flow. This can be especially beneficial for you as you look for a passive source of income. Number 3, appreciation. Real estate values can appreciate over time, providing a potential long-term return on investment. This appreciation can be driven by a variety of factors, including location, market demand, and property improvements. Number 4, leverage. Real estate can be purchased with a mortgage, which allows you to leverage your investment and potentially increase your returns. However, this also means that you are responsible for paying back the mortgage, as well as any other expenses associated with the property, but this allows you to have better control of your finances. Number 5, tax benefits. Real estate investments can provide tax benefits, such as deductions for mortgage interest and property taxes. These benefits can help reduce the overall cost of owning and maintaining the property. Now let's look at commodities. Consider allocating $20,000 to gold. If gold prices appreciate, your investment grows. For instance, a 10% increase results in an additional $2,000. Commodities acts as a hedge against economic uncertainties, adding another layer of security to your portfolio. Commodities refer to basic goods used in commerce such as agricultural products, natural resources, and minerals. These goods are often traded on commodity exchanges such as the Chicago Mercantile Exchange or the London Metal Exchange. Investing in commodities can provide a hedge against inflation, as the prices of commodities tend to rise when inflation increases. They also provide a source of diversification, as their prices can move independently of other asset classes, such as stocks and bonds. Next is paper assets. If you invest $30,000 in a diversified portfolio of stocks and bonds, and it grows at an average rate of 7% annually, your investment could potentially double in around 10 years. That's the magic of compounding and the potential of paper assets to deliver significant returns over time. Paper assets are financial instruments that are represented by physical documents or digital records such as stocks, bonds, and certificates of deposits. These assets are considered better than cash in several ways. Number 1, liquidity. Paper assets can be easily bought and sold on financial markets, providing liquidity to the owner. For example, if you own shares of a company, you can sell them quickly if you need cash. Number 2, diversification. Paper assets can help diversify your investment portfolio, reducing your risk and increasing potential returns. For instance, if you own a mix of stocks and bonds, you can reduce your exposure to market volatility. Number 3, potential for growth. Paper assets have the potential to increase in value over time, providing a potential long-term return on investment. For example, if you invest in company stocks and it performs well, your shares may increase in value. Number 4, income generation. Some paper assets such as bonds and certificate of deposits provide regular interest payments or dividends, providing a steady income stream. Again, allow me to explain this with Sarah's inheritance. Sarah has inherited $100,000 from her grandmother. Sarah is cautious with her money and wants to invest it wisely. She decides to put $50,000 into a high-yield savings account, which earns her 2% interest per year. She also invests $30,000 in a diversified portfolio of stocks and bonds, which has the potential to grow in value over time. After 1 year, Sarah's savings account has earned her $1,000 in interest, while her stock and bonds portfolio has grown by $5,000. Although the stock market can be volatile, Sarah's diversified portfolio has helped her ride out any fluctuations and potentially earn a higher return than if she had kept all her money in cash. In contrast, if Sarah had kept all her money in cash, it would have earned her only $500 in interest over the same period, leaving her with a total of $105,500. By investing in paper assets, Sarah has potentially earned a higher return on her investment and has the opportunity for long-term growth. If you're finding this guide to 10xing your investments insightful and you're eager for more strategies to maximize your wealth, hit that subscribe button now. Join the community of fun financial insights, and let's continue this thrilling journey to financial mastery together. Now that we've covered the assets, let's discuss how to convert your cash into these wealth-building vehicles quickly. Tip number 1, educate yourself. Take the time to understand the different investment options available. Attend workshops, read books, and learn from successful investors. Knowledge is your most powerful tool in making informed decisions. Tip number 2, start small, scale smart. You don't need a fortune to start investing. Begin with what you have, be it $500 or $5,000. The key is to start and then scale your investments as you gain confidence and experience. Tip number 3, seek professional advice. Consider consulting with financial advisors or mentors who have experience in the areas you're interested in. Their insights can help you make more informed decisions and avoid common pitfalls. If you've enjoyed this journey through the world of wealth building with Robert Kiyosaki, don't forget to give us a thumbs up, share this video with fellow enthusiasts, and subscribe for more mind-blowing financial insights. Your journey to financial mastery has just begun, and we're thrilled to be a part of it. Stay tuned for our next episode where we reveal more ways to achieve financial success. Until then, keep exploring, keep learning, and always remember, your wealth is within your reach. Subscribe now for more financial adventures with fun financial insights.